There is a line where dividend income stops being tax-free and starts costing you, and it is much further out than almost anyone guesses. Here it is. If you are single and under 65, you can receive $65,550 of qualified dividends in 2026 and owe zero federal income tax on them. $65,550, which is roughly 4 times what most people assume the line is. Tax-free, entirely legally, with no clever structure involved anywhere. That figure is correct, and there is a condition attached to it that changes everything. It holds only if those dividends are your only income. The moment you have a salary, a pension, a withdrawal, or anything else arriving on the same tax return, that line starts sliding downward, and it slides dollar for dollar. Almost nobody has no other income, which means almost nobody's real line is the one I just gave you. Vince and Gordon are going to show you what that looks like. Both 55, both single, both with identical portfolios paying them exactly $30,000 a year in qualified dividends. Same holdings, same dividends, same tax return form. One of them pays nothing. The other pays $3,667.50 on his. Before that, where $65,550 comes from, because it is 2 numbers added together and most people only know about one of them. The first is the 0% bracket. Qualified dividends and long-term capital gains have their own rate schedule, separate from ordinary income, and the bottom rung of it is 0. For 2026, from IRS Revenue Procedure 2025-32, that 0 rate applies as long as your taxable income stays at or below $49,450 single or $98,900 married filing jointly. Above that, it is 15%. Qualified, by the way, means the dividend earned the lower rate, which most ordinary company dividends do if you held the stock long enough. The IRS is specific about it in Publication 550. More than 60 days during the 121-day window that begins 60 days before the ex-dividend date. The second number is the standard deduction, which for 2026 is $16,100 single and $32,200 married. That comes off before anything is taxed at all, so the two stack. $49,450 of 0% bracket plus $16,100 of standard deduction is $65,550 of dividends before a single dollar of federal tax. Your own version is one subtraction. Take the 0% ceiling for your filing status, subtract your taxable income from everything that is not dividends, and what is left is how much dividend income you can receive at 0. That gap is the whole game, and I would encourage you to work it out tonight. The free calculator in the description will do it if you would rather not. Keep hold of that subtraction, because I am coming back to it. And the thing sitting on the left side of it is not what you think it is. Now, if you are married and older, the number gets genuinely surprising. Taxpayers 65 and over get an additional standard deduction on top of the regular one. For 2026, that is $2,050 if you are unmarried, or $1,650 per person if you are married. And there is a new one on top of that, created by the legislation passed last year, which the IRS calls the enhanced deduction for seniors. $6,000 for a single filer 65 or over, $12,000 for a married couple where both are. Add it all up for a married couple where both are 65 or over. $98,900 of 0% bracket, $32,200 of standard deduction, $3,300 of the age addition, and $12,000 of the senior deduction. That is $146,400 of qualified dividend income with 0 federal income tax owed. I will give you the portfolio behind that once and then move on, because it is not the useful part of this video. At a 3.25% yield, which is SCHD's 30-day SEC yield as of August 6, 2026 from Schwab, $146,400 of dividends implies about $4.5 million. If you are sitting there thinking that has nothing to do with you, you are right. And that is exactly why the portfolio is the wrong thing to focus on. 2 things about that senior deduction before we go on, because I would rather you hear them from me. It starts phasing out above $75,000 of income for a single filer and $150,000 for a couple. And under current law, it expires after tax year 2028. If you are 53 today, you will not be eligible for it until you are 65. And on the books right now, it disappears 12 years before you get there. Which brings me to Vince and Gordon, because the number that actually decides your tax has almost nothing to do with your dividends. Vince and Gordon. Both 55, both single, both taking the standard deduction. Both hold the same portfolio paying exactly $30,000 a year in qualified dividends. If you compared their brokerage statements line by line, they would match. Vince retired early. The dividends are his entire income. Gordon still works and earns $60,000 a year doing it. Before I give you the two bills, take a guess at Gordon's dividend tax. Same $30,000 of dividends, same funds, same holding periods, same everything the brokerage reports to the IRS. Hold a number. Vince, first. $30,000 of dividends minus his $16,100 standard deduction leaves $13,900 of taxable income. All of it qualified dividends. The 0% ceiling is $49,450. He is nowhere near it. Vince's federal tax on $30,000 of dividend income is zero. Gordon now, his $60,000 salary minus the same $16,100 standard deduction gives him $43,900 of ordinary taxable income. And this is the part that decides everything. Ordinary income does not sit alongside your dividends on the tax return. It sits underneath them. The IRS computes this on the qualified dividends and capital gain tax worksheet, and that worksheet stacks income in a fixed order. Wages, pensions, interest, and retirement withdrawals fill the bracket from the floor upward. Dividends and long-term gains go on top of whatever is already there. Then each dollar is taxed according to where it landed in the stack. So Gordon's $43,900 of salary has already consumed almost the entire 0% band. The ceiling is $49,450. He has $5,550 of room left. $5,550 of his dividends are taxed at zero. The remaining $24,450 are taxed at 15%, which is $3,667.50. Identical dividends, identical portfolios. One man pays nothing, and the other pays $3,667.50. And the dividends had absolutely nothing to do with the difference, which raises the fair question of what you actually do with that. And there are three answers. The first is to control the ordinary income rather than the dividends. Everything sitting underneath your dividends is what moves your line. So anything discretionary down there, a retirement withdrawal, a Roth conversion, selling a rental, is really a decision about your dividend tax whether you think of it that way or not. And the leverage on that is larger than people expect because it is one for one. Every dollar of ordinary income you avoid this year is a dollar of dividend room you get back. And at the 15% rate, that is 15 cents saved for every dollar you did not take. If Gordon had dropped to 4 days a week and earned $45,000 instead of $60,000, his ordinary taxable income would fall to $28,900. His 0% room would grow from $5,550 to $20,550, and his dividend tax would fall from $3,667.50 to $1,417.50. He would give up $15,000 of salary and get $2,250 of it straight back in tax he no longer owes. The second is to check what you actually own, because not every dividend gets the lower rate. Publication 550 names two categories explicitly, and both are things people hold without thinking about it. REIT, dividends never qualify, and neither do money market fund dividends. Those get taxed as ordinary income, which also means they sit underneath your other dividends and push them upward. Beyond those two, covered call funds and business development companies commonly pay non-qualified income as well, though that follows from how those structures work rather than from a line in Publication 550, and I would rather tell you that than pretend otherwise. The third is geography, and it is more real than people expect. New Hampshire finished repealing its interest and dividends tax for tax periods beginning January 1st, 2025. And the state has told taxpayers there is no return to file at all. Tennessee repealed its equivalent back in 2021. And Washington, despite having a 7% capital gains tax that gets a lot of attention, states in its own Department of Revenue guidance that dividend distributions are not subject to it. There are two more lines further out that are worth knowing exist because both of them work the same way and neither one moves. The first is the 3.8% surtax on investment income, which starts at $200,000 of modified adjusted gross income if you are single and $250,000 if you are married. Those figures were written into law in 2013 and have never been adjusted once. Everything else in the tax code gets an inflation adjustment every year through a revenue procedure. These two do not. The second matters much more to anyone approaching retirement. Your dividends count toward what the IRS calls provisional income, which is the figure that decides how much of your Social Security gets taxed. 50% of your benefits become taxable above $25,000 single or $32,000 married, and 85% above $34,000 or $44,000. Those thresholds were set in 1984 and 1993, and the Social Security Administration's own policy office confirms they were deliberately never indexed. So dividend income you built specifically to fund retirement can, on the way in, make your retirement benefit taxable. Now the mistake, and I have been circling it since the first minute, the mistake is watching the wrong number. People building dividend income track the dividend income. They watch it grow, and somewhere in the back of their mind there is a vague worry about a line they will cross one day. Meanwhile, the line itself is moving every year, driven entirely by things on the other side of the return, and a raise at work moves it further than another year of dividend growth ever will. Which is the whole thing, so let me put it plainly. The line in the title is real, and it is not a property of your dividends. It is a property of everything else on your return. Vince and Gordon own the same portfolio and receive the same dividends on the same days, and the tax code treats them completely differently because of a number that has nothing to do with either of those things. So here's what you own now. The 0% ceiling, 49,450 single and 98,900 married. Your deduction stack on top, which for a couple both over 65 reaches 47,500. The subtraction, ceiling minus everything that is not dividends. The stacking order, ordinary income at the bottom and dividends above it. And the two things publication 550 says will never qualify no matter how long you hold them. Gordon is not doing anything wrong. He has a job, which is the most ordinary thing in the world, and it happens to be sitting underneath his dividends pushing them up a bracket. That is worth knowing about before you plan around it, and it is worth knowing about now rather than in the year you retire. Tell me where you land, and be specific so the comments are useful. First, run the subtraction and tell me how much 0% room you actually have left after everything else on your return. Second, do you hold anything that can never qualify, REITs or money market funds, and did you know they were taxed differently? And third, for anyone within a few years of stopping work, have you worked out how much your line moves the year the salary disappears? Put it below. If the IRS side of this is the part that interests you, the rules around what your bank reports and when are stranger than most people realize. And the IRS doesn't want you to understand. This $10,000 bank rule goes through exactly that. None of this is financial advice, and I am not your accountant. It is Revenue Procedure 2025-32, Publication 550, and 3 state revenue departments with the arithmetic run in front of you. Here is the math. You decide.